Hi everyone, good morning to all of you. My name is Ishwari Menon. I'm a lecturer from Segi College, Kuala Lumpur. Today I'm going to discuss my topic in webinar, businesses and financial statements. Okay, I start with what is business. I hope everyone know the definition of businesses, but I would like to share some references for you to define what is business. Business and organizations or enterprising entity engaged in commercial, industrial, or professional activities. Business also refers to the organized effort and activities of individual to produce and sell goods and services for profit. Business is an organization or economic system where goods and services are exchanged for one another for money. Business also is either your occupation, profession, trade, or a commercial activity which involve providing goods or services in exchange for profit. So generally, I put business in this diagram. Okay, business must have selling and buying process. Okay, must have seller or and buyer. And for selling, okay, the person who sell the goods we know them as a supplier or trade payables. For buyer, we know the person as a customer or trade receivable. So in between buyer and seller, we have organizations or company that are dealing with these two activities, buying, selling. And those activities, business activities that happen in company, we call them as transactions. And these transactions need to be recorded in our book. In accounting, we call as a bookkeeping. Okay, now we look what is bookkeeping or record. Bookkeeping involves double entry of business transactions, which is debit and credit. In bookkeeping, we need to record all the day-to-day transactions in relevant accounting books like journal, cash book, bank book, and also ledger. Okay, now we see what is the reason of bookkeeping. Bookkeeping is for we keep bookkeeping for better financial planning and management because company need to do long-term strategies, long-term planning in finance. So they need to have a proper record to refer for better financial planning and management. Second is for tax obligation. Tax obligation is for company to pay the tax. Okay, so they must have a book keeping or proper financial statement to determine the tax to be paid. Third reason is for businesses to use for future and long-term planning. This one for business to make a long-term investment or long-term decisions to expand or grow the business. So they need to have a proper bookkeeping or financial statement to make a decision internally or externally. Finally, to communicate to stakeholders regarding companies' finance and profit or losses. Okay, so as we know, company involve a lot of stakeholders, internal and external stakeholders. Okay, those stakeholders are they are involved in business activity directly or indirectly. So they also need to know the informations regarding the company operations and statement for them to make a further decisions, right? Next, we look into the type of businesses. Okay, first is sole proprietorship or sole trader. This is a business run by one person. Okay, usually for this type of business, need a very less capital, very small type of business, very easy to set up. They don't have much transactions or requirement legally to set up this business. Second is partnership. This business run more than two-person. Okay, they need to register this business under Partnership Act 1961. Okay, and then they have a few agreements to sign up among the partners regarding the capital contributions, sharing of profit loss, and so on. Third type of business is corporation. This is very huge business. Okay, like in Malaysia, we have Sendirian Berhad and Berhad, private limited, public limited company. These two type of business known as corporation. Okay, this business also need to register, okay, legally under Corporation Act 2001. All right, and the fourth one is non-profit organization. This type of business is not motive of profit, but they are more to welfare and charity purpose. Okay, they help communities or society of their well-being. Uh, Next is franchise. This is also nowadays a very famous and well-grown business. Franchise, okay. This type of business, the franchise business is actually they owe license from the franchisee. All right, and the franchisor has to assess business property knowledge, process, and trademarks, similar as franchisee. The last one is joint venture or merge. Okay, merge actually is a two and more business combines. Okay, their forces and become a new business. They have a separate entity. Okay, and the original company no longer exists. For the joint venture, same as merge. Okay, there are two or more businesses. They combine and share their resources to pursuing a specific goal, and the original company still exists, and they run separate as a separate entity. Okay, now I would like to share the financial statement of the first three type of businesses just now. Okay, for sole proprietor, as I mentioned earlier, these business are very small and easy to set up. No need to require much capital. So this business has less transactions in their financial process. Okay, so normally for the statement, for the comprehensive statement, look as simple as this, whereby they have a sales and other income, other expenses in the company, and finally they declare the profit. Okay, this profit belongs to the owner. Okay, whereby when we look at the sole proprietor's statement of financial position, also are very simple and easy. Okay, they don't have any much transactions here. When look at the owner's equity for the sole trader or sole proprietor, they only have capital. This capital belongs to the owner, and the profit from the comprehensive statement, and finally they minus with the drawings if any partner draw goods or cash from the business for personal use. Okay, let's now we look into the partnership type of statement. Uh, Partner statement, you can see the partner's name into the statement, in the financial statement. Okay, for example, like this one is comprehensive income statement and also appropriation account. Why here we combine appropriation account for partnership? Because partnership need to show the agreements, okay, the terms and condition, the agreement that they have signed up in the partnership act regarding the interest need to be paid on the capital, interest need to be paid on drawings, partner salary. If let's say that partner is work directly to the business, okay, and finally the sharing of profit loss. Okay, so from the comprehensive statement for partnership, we extend a bit longer after calculate the profit. Okay, we extend a bit longer from the profit for the year. Okay, we calculate other adjustment or agreement that partners already made in their terms and condition. Okay, in the partnership agreement. Okay, uh, all right. How differ the financial position from the sole trader just now? Okay, for in this case, again, the changes happen in the honest equity. Okay, for partnership account, they have capital on the partner's contribution on the partner's name. Okay, we want to list how much capital contributed by the partners. Okay, for this example, you can see Ramli and Ramu, right? So Ramli and Ramu is a partner, so each of them contributed this much of amount in the capital. And also current account. Current account actually similar as appropriation account. Okay, we do a adjustment on the partners agreement again in the current account to transfer this to the financial position. Okay, so the changes between the sole trader to partnership is actually in the honest equity. All right. Uh, Next is corporation. Corporation is the business, very huge business, as I say. Okay, so normally corporation type of business, they entitled to sell or issue shares. All right, so they can sell shares to public to expand or grow their business. So when you look at the comprehensive income for corporation type of business, they still work similar as before. Okay, start from sales until the net profit. But now the net profit name we change to either operating profit or profit before interest and taxes. Okay, because corporation need to pay interest on the debenture or loan and also tax to the government. So the statement look a bit different in terms of the terms of accounting they used in the statement to represent. Okay, so after you can see the side at the side of the box you have appropriation account. So this is actually explain, okay, tell the company how much dividend that they're going to pay for the preference shareholder and also ordinary shareholder. Okay, the dividend for ordinary share and preference share will be paid after deduction of interest on the debenture and also tax. After minus these two components, then they will calculate how much to be paid to the shareholders. And also general reserve, for example, general reserve, let's say company decided to allocate a portion of amount from the profit as their general reserve, then that also need to be minus under appropriation account. Then finally, they will come with the retained earning or net income. Okay, this retained earning or net income will be transferred to the statement of financial position. Okay, this is the financial statement, statement of financial position. Okay, the changes again, look at the finance by. Previously, I used as honest equity. For sole proprietor and also partnership, we use as honest equity. And when come to corporation, we use finance by. Okay, so the share capital actually is company's share. Okay, which is the ordinary and preference share. Okay, so normally company will list the unit of share, the price per unit, and the total value of that share. If you look at the preference share, they will come with the percentage. Okay, let's say 7% of preference share. Okay, meaning the 7% is the dividend that preference shareholder going to be received every year. Okay, now and also the general reserve that they incurred and they want to assign from the profit of the company. Also, they have to transfer under the finance by, followed by non-current liabilities, the debentures. Debenture actually is a kind of loan, okay, where the company need to pay the interest. And two more component addition in added in current liability is your dividend payable and tax payable, because these two um, expenses, right, we already declare in the statement, but we did not pay the cash. So still we have the outstanding as a payable for dividend and tax, which should be listed under the current liability. Okay, that's all for my webinar sessions today. Thanks for listening and watching. I hope you can understand the concept of businesses and how the statement to be prepared for each type of business just now. Okay, thank you, and um, have a nice day.